Alrighty, Accounting 2301, Chapter 1 through 4 project. Let's get started. So, this right here, how do you record the journal entries A through J? Basically, journal entries record business transactions using debits and credits. Each entry identifies the accounts affected and keeps the accounting equation balanced by making sure total debits equal total credits. So we'll go through 4 of these out of A through J. We'll go through A, F, G, and J. First one, borrowed $18 cash on July 1st, signing a 6-month note payable. Well, we debited cash $18 and credited notes payable $18. This is because cash increases since they received money, and notes payable increases because the company now has a liability to repay the loan in the future. F, on December 6th, recorded revenues in the amount of $61, including $8 on credit and $53 received in cash. This is a partial payment. I debited cash $53 and accounts receivable $8 to indicate the separate methods of payment, like I said, and credited service revenue for $61 to indicate an increase in their revenue. And this can be seen right here. So cash and accounts receivable are both debited, while service revenue is credited for an amount equal to both of these. I debited salaries and wages. Paid salaries and wages expense on December 7th for $22. So I debited salaries and wages expense for $22 and credited cash for the same. Salaries and wages increases because the company incurred the cost of paying employees, and then cash decreases because the company paid the employees in cash. And that can be seen here, 22 and 22, debits equal credits. For J, received a $5 deposit on December 10th for work to start January 15th, 2025. So I debited cash $5 and credited deferred revenue $5. Cash increases because the company received money from the customer, and deferred revenue increases because the company has not yet performed the service and therefore owes work in the future. And that entry can be seen here. All right, so how do you enter beginning balances and post the journal entries to the T accounts? And all this is basically saying beginning balances from the trial balance are entered into the T accounts. Each journal entry is then posted to the appropriate account with debits on the left and credits on the right, which allows us to track the updated balances. So this is our trial balance. You'll take your, some of these are just highlighted for example purposes, so we don't have to, waste 3 hours of your time going through every single one of these. Basically, our trial balance for cash is $6, so we'll pull that right over here. My face is covering it a little bit. This says beginning balance for $6. That matches here, $6. Equipment for $5. Same thing, debit that for $5 for our beginning balance. And that'll all flow through every single one of these. So accounts receivable, $3. Supplies, $3. Boom. And like I said, that'll go to every single one of these and all the other T accounts. So then you'll post your journal entries to the T accounts. We'll see here that equipment for 21 will flow through here. B, your T accounts will always have letters for the problems they correlate to. Your cash is credited for 21. That can be seen up here. Once all of our transactions flow through, we'll get an ending balance, and this ending balance is important for the next thing. So how do you create an unadjusted trial balance? Well, all this is saying, after posting journal entries, the ending balances from the T accounts are listed in the unadjusted trial balance. Debits and credits are totaled to confirm that the ledger remains balanced. So like I said, those ending balances are important. Grab our ending balance from cash, boom, 36. Ending balance from equipment, 30, boom, 30. So everything will flow through as long as it's for the proper accounting period. Anything outside of that, if there's transactions, things are getting paid later, anything like that, outside of the accounting period, they're not necessarily going to match up perfectly. Which is why it's important for us to have so much financial data. So I put these 2 questions together because it's actually a lot easier to explain everything when you can see it all in one. Basically, adjusting entries update account balances at the end of the period. These entries record items like accrued expenses or depreciation, so revenues and expenses are reported in the correct accounting period. After adjusting entries are recorded, they are posted to the T accounts just like regular journal entries. This updates the account balances and prepares the ledger for the adjusted trial balance. And that's what all that says. So first thing you'll do is these are K through P right here. So for example, amortization for 2024 of $5. So we'll come over here to amortization expense. We'll debit that for $5. And then we will credit accumulated amortization for $5, and then those will each flow down into transactions within our T accounts. So this is the answer to question 4 and question 5. Question 4 is how do you record the entries, and then question 5, how do the entries flow to the T accounts? So how do you prepare an adjusted trial balance? Well, the adjusted trial balance lists the updated balances from all accounts after adjustments have been posted. Debits and credits are checked again to ensure the ledger is still balanced before preparing financial statements. So this one's really easy. You take all of your ending balances and you just throw them into your adjusted trial balance. And the way you know you're correct is if your debits and credits match. Real simple. So your ending balance for cash is 36. Boom, 36 for cash. Ending balance for accounts receivable, boom, $4. And that'll flow through 5, 30, 30, and they'll all do that. And you just want to make sure when all is said and done, does this equal this? In our scenario, 131 is equal to 131. Yes. Now, how do you prepare an income statement? Well, the income statement reports revenues and expenses for the period. By subtracting total expenses from total revenues, we determine the company's net income or net loss. So, our adjusted trial balance, in relation to the income statement, this highlighted portion is the only portion that's relevant. None of that matters. So in our case, in this specific company, Lazy Sofa Furniture, they only have one account of revenue. So service revenue for 61 will get recorded up here, right below the main header of revenues. Then that'll flow to our total revenues. In this case, it's the same number since they only have one account. Pardon me. Same thing here, main header. For our expenses, they have multiple accounts for expenses. All companies do, unfortunately. Those will flow through the same. Supplies expense 7, salaries and wages 24, 1536, 1536. Now, what happens next? How do you prepare a statement of retained earnings? Well, statement of retained earnings shows how retained earnings change during the period. It starts with the beginning balance, adds net income, subtracts dividends, and calculates the ending retained earnings. And in the case of this company, they do not have dividends, by the way. So, our net income is $15. Same income statement as the prior slide. We're looking at the same stuff. Our adjusted trial balance, we only need this one thing right here, so it's all cropped down to this one account. This right here is coming from the entire trial balance, but it's just all smushed down to show this one account. So your net income is added to your statement of retained earnings right here. Add net income. You'll take your beginning retained earnings balance of $2. If we had dividends, we would subtract them, and then all that brings us our new retained earning balance. So if we were to present this as an equation mathematically, it would be 2 plus 15 minus 0 in our case equals 17. So this is our new retained earnings. Old retained earnings, new retained earnings. So how do you prepare the balance sheet? All this is saying, the balance sheet shows a company's financial position at a specific date. It lists assets, liabilities, and stockholders' equity and verifies that assets equal liabilities plus equity. Assets equal liabilities plus equity. Very important. Anybody should know that. It's the basic accounting equation. So this is a lot to look at, but it is color-coded a little bit to make it simpler. So your trial balance will be, when you generate it, it will be sorted where your assets are first, then your liabilities, and then your stockholders' equity. And in this case, we can ignore all of our revenues and expenses because they're not relevant to our balance sheet. And then we'll also need our statement of retained earnings because this one thing will flow over into this one thing over here, and that's how we make everything equal. So our balance sheet will have assets into two categories, our current and non-current assets. Our liabilities are the same thing, current and non-current. In the case of this company, they don't have any non-current assets, which is why it just goes from current to total current, because like I said, they don't have any non-current. So we'll take our cash, accounts receivable, and supplies for 36.4 and 5, 36.45. That'll all be our total current assets of 45. Equipment, accumulated depreciation, so on and so forth for 30. This is less or subtract 1, which is why it's on the credit side over here, because the standard balance of an asset would be a debit. So if it's in the credit side, we subtract that. Software for 10, same thing. All that will get added. And we're also adding our total current assets into this number. Total liabilities, basically the same thing. Like I said, in this case of the company, there are no non-current assets, so we'll just take 518.2, accounts payable, notes payable, salaries and wages payable. Anything payable is going to be a liability as long as it's short term. Accounts payable, notes payable, salaries and wages payable, 518.2. That'll all flow through. Same thing. Your common stock is stockholders' equity, so that will flow through 418. Like I said, we'll come and view our statement of retained earnings and see that our new retained earnings balance is $17, so that flows through here. We get our total stockholders' equity for 35, and then we get our total liabilities and stockholders' equity. So we add this 74 with this, we add the 35 with the 39. That gives us 74. How do we check our work? Well, 74 equals 74. Did a good job. All right. How do you prepare the closing entry? All this is saying closing entries transfer the balances of temporary accounts like revenues and expenses to retained earnings. This resets those accounts to 0 for the next accounting period. So we look over here at our adjusted trial balance and our general journal. So we are closing out our temporary accounts. Now we will look here first. Service revenue 61. We'll notice this is on the credit side. Oop, we come over here, it's on the debit side. And this is because our debits equal credit. So if we have 61 for a credit on one side and 61 for a debit on the other, they wash. Nothing's left. And that's going to repeat for all of these. For our expenses as well, the standard balance we got here is a debit. Pull them over as a credit over here. That washes everything out. So all these accounts will turn to 0. How do you post the closing journal entry to T accounts? Well, after recording the closing entries, they are posted to T accounts. Revenues and expenses accounts end with 0 balances, while retained earnings is updated with the period's results. Like I said, revenues and expenses accounts end with 0. So we will bring all of these closing entries to the T accounts, which is why this says CE, because that's saying closing entry, whereas a lot of these will have a letter, which is for the problem they are associated with. CE is closing entry. These are specifically associated with the closing entry. So service revenue for 61, that's a debit. We'll come over here, debit for service revenue 61, CE. Same thing, we could look at our retained earnings, 15. This end balance, like I said before, is still important. 7 for the supplies expense on the credit side. Supplies expense, where are you? 7 on the credit side, and that repeats for all these. So only our revenues and expenses will get a closing entry related T account entry. So how do you prepare a post-closing trial balance? Well, the post-closing trial balance lists only permanent accounts after closing entries are complete. This confirms the ledger is balanced and provides the starting balances for the next accounting period. What does that look like? Well, like I said, boom, all this that was once here is now 0 because these are temporary accounts that we need to wash out. Retained earnings, that will flow through to our new number of $17. All of our permanent accounts will stay in the post-closing trial balance. And here we have left our totals. 85 equals 85, debits equal credits. And that's your boy, John Henry Baum. Chapter 1 through 4 accounting project, done. Thank you, ma'am.